I did want to have a slide too, talking here, you'll see about sort of the selection criteria. So, in terms of receiving the transactions that may go into the study, we receive those from a number of different data sources. Most recently, it's been coming from Sagent through BVR. And really the first point here, it's important to note that when we receive those transactions, they go through an intense screening process, which I'll talk about, but they are added with a 2-quarter lag. And we'll talk about this a little bit more, but it essentially allows for appropriate amount of time for sufficient disclosures to come out around the transaction so that we can appropriately review and screen whether or not it's an appropriate transaction to include or exclude for various reasons. So for example, right now, given the date, September 26th, we're just about wrapping up going through the screen of transactions through Q4 2023. And then obviously once September 30th kind of passes, we'll be able to start screening transactions through March 31st, 2024. So that's where that 6-month lag kind of comes into play. This second bullet may be one of the more important ones in the presentation, obviously, but once we get those transactions, we go through a very rigorous screening process of every transaction to determine whether or not we feel like it's appropriate to include, and I'll get into that a little bit more, but we go through and review all the relevant public filings, 10Ks, 8Ks, 10Qs, purchase agreements, registration rights agreements, just to understand sort of the facts and circumstances in play with each transaction. So this is where we're somewhat dissimilar from, for example, the Plurus database that's out there that I know a lot of folks use and can also license and subscribe to help support discounts. I think that database, last time I checked, had over 3,500 transactions, so significantly more transactions. But my understanding is the process to rule out particular transactions is not as rigorous as ours. So, I won't go as far as say there's strengths and weaknesses, because I'm obviously very biased in terms of what study I think is probably the best to use, obviously being the Stout Restricted Stock Study. In terms of going through these transactions that we receive, literally probably over 95% of them, we remove them or eliminate them for various reasons, which is what we kind of list here. When we're considering fair market value, right, as sort of our standard of value, we have to consider willing buyer, willing seller, not specific investors or specific synergies or premiums that may be applied. So we really need to go through these transactions and understand, really only focus on sort of the plain vanilla type restricted stock transactions that may not have certain uniqueness that would cause the discount to be artificially higher or lower, and thus not a good comparison to use in our analysis. So it's important to note that that's really the big driver in terms of the difference. And I can certainly talk more about it, but just want to at least highlight it here. And then the third bullet, here's a list of really some of the main reasons why we're going through all these transactions and eliminate them for various reasons. So first, maybe the transaction was not a private placement of unregistered shares. We see that occasionally where they're already registered or shelf sale in that case. The private placement may include debt, preferred, convertible preferred, some other hybrid-like security that may not be identical to the publicly traded stock. Obviously, like I said at the beginning, right, we want to get two securities that are the exact same, the only difference being one is freely tradable and the other one has sort of this temporary illiquidity associated with it. If we start comparing various types of securities, that you're sort of comparing an apple and an orange in that case, and looking at the implied discount on those transactions isn't correctly impacting the features or isn't correctly being affected by the economics that we want it to in that case. Number three, the private placement was issued as part of a stock warrant unit or had warrants attached to it. It's possible the transaction did not close. It was announced but later withdrawn, and that's in part why we have this 6-month lag to kind of capture all those circumstances where maybe there was an announcement made, but if it did not close, we wouldn't want to include it in our database. Number five, the stock was not traded on domestic exchange. Could have been a 6K filing company, and that may have other rules or regulations that we'd want to strip out. Number six, the stock traded below $1 for the entire month of the transaction, or it had very low volume. So again, this kind of goes back to similar to number two, but any sort of penny stock type valuations, the volatility of the stock price, or if it doesn't trade in a kind of an appropriate daily volume, the implied discount that's calculated could be skewed based on other factors at play. So we typically try to screen those transactions out as well. Number 7, if we're unable to determine certain pieces of information, financial information, proceeds information, we typically strip those out if we can't verify them. Special contractual agreements between the buyer and seller. That's an important one. If the stock was issued in connection with a strategic business relationship or some sort of strategic alliance between the buyer and seller as part of an M&A transaction or something like that, there's other factors at play that we wouldn't want to include. And then lastly, really the lead purchaser was a related party. Maybe sometimes we see that they receive board seats as addition to the transaction that again would impact the price that's ultimately agreed to as part of the private placement transaction. So it's important to note too that the Stout study, dissimilar from some other studies out there, we do remove or exclude any implied premiums. So obviously opposite of discounts in the study. Likely in those situations, right, it's hard to believe that if you're dealing with 2 identical securities, one you can sell and one you can't, that the one you can't sell would be worth more in that circumstance. So sort of just the concept or the framework of lack of marketability somewhat breaks down that case. So with these transactions, we obviously do our best to understand all the details we can, but obviously there's only so much that's publicly disclosed. So our presumption is, in those cases, is there's usually some fact pattern behind the scenes that is impacting the relative price that's agreed on. So we typically exclude those in the study as well.